So Nigeria's earnings season is here, while the corporate news box is also filled for investors and analysts weighing the news and other announcements for their trading positions. Let's track some of the headlines in the current market week as we turn to Ayodeji Ebo, who is the head of retail investment at Chapel Hill, Denham. Good evening, Ayodeji. Thanks for coming through.
Good evening. Thanks for having me.
It's great to have you on the show. Thank you. How's the market weighing the news of Axaman that we just talked about, the share reconstruction plan? What did it mean for investors or shareholders? And why is this insurance company looking to rejig the total shares that it has on the market right now?
Okay, thanks. I think the news came after the market has closed. So a suspension, technical suspension will be implemented tomorrow. It means that there will be no trade on the stock tomorrow. And what we expect to see is when you look at the current shares outstanding of AXA Mansard, about 36 billion. And based on the share capital reconstruction they are doing, increasing the nominal value from 0.5 naira per share to 2 naira per share. That means that the shares outstanding will reduce to 9 billion, while the share price, once trading starts, will open at 2 naira 32 kobo, based on closing price of today of 0.83 kobo. So what that just does, most times, in terms of value, your value will not change based on reconstruction. It means the units you are carrying will reduce. If you have 10,000 units, you divide that by 4, it will reduce to 2,500. Then the price will also increase. So your value always will remain the same. So what will drive appreciation going forward is based on profitability. But in terms of perception, so when you look at the per share data, earnings per share, dividend per share, now that the shares outstanding has reduced. So, like based on their forecast, their projection for this year about 4 billion. So when you look at that relative to 9 billion compared to before, that would have been 36 billion. So it looks a bit substantial based on perception, but it still boils down to the yield, because when you compare it to price, will still, if nothing has happened, will still give you the same yield. So by and large, I feel that investors would only be moved by their profitability, and not really the share construction really doesn't change their current position. So there's really nothing to fear. But at least in terms of shares outstanding, we may be seeing more movement in the share price of the stock due to the reduced shares outstanding.
Interesting how the share reconstruction and is doing the share repo works in the market. It's a little bit tricky, by the way. You need to be sure of what you are doing when you do these things. Like you said, whatever it is, you need to make sure that the shareholders get a better end of it. But let's talk about Nigeria's largest brewer, that's Nigerian Breweries. The news is that it paid about 27 billion on its debt book in the first half of the year. So that means that after the pandemic, folks get back into parties and a whole lot of having nice times all around. So should the investors price this information into Nigerian Breweries' share price or valuation, Ayo?
Yes, I think when you look at the impact of paying down debt on any company, it means that your finance costs will reduce, which leaves more for equity shareholders. Because when you see the structure of the financial statements, you discover that you need to pay the debt holders first. It is what is left that is distributed, or out of it that is distributed to equity holders. So that is why equity holders would I would say responded positively. You would see yesterday, but I think today there was really no movement on the share price. But overall, it was going to be positive for the company's profit, PAT, or I would say bottom line. And we hope that they would also just be able to sustain their profitability. When we looked at their half year, last year there was almost a full lockdown, and based on a lower base effect, it looks like they have improved but there's still that sector. There's a lot of competition, stiff competition within that space. They're unable to pass all the any price increase, any major cost to the consumer, because consumer wallet is also being pressured, and there's a lot of price competition going on within that sector.
Okay, let's take it from brewery, from insurance to the banking space, because the latest data from the central bank show that the oil and gas and power sector still owing banks about 6 trillion naira in debt. This should be a major concern for the investors, even the central bank, isn't it? That's a whole lot of money.
Yeah, but what I would say is that this is not new. We know the oil and gas sector is like is a major sector where banks lend to. When you look at their books, most times it's always like 30% or more of their total loan books. The only issue that or major concern most times is if there's any major volatility in oil prices. So, for instance, last year, if not for the forbearances that they got from the CBN, most of those loans would have gone bad. But we've seen oil prices rally back to almost $70 per barrel. So that is also positive, because even within the oil and gas sector, they are mostly exposed to the upstream oil and gas space. So yes, it's cause for concern based on the amount, but we know that's the major area where we feel that the banks feel a bit comfortable. Maybe they also understand the business more, and we don't most times you don't see them invest heavily or borrow heavily to that sector compared to the oil and gas space. So I think over time, with if oil price can remain very stable with the PIA that's been passed, they can implement the regulation in the downstream space. There will also be uptick in activities, and banks will be able to fund transaction within that space, and that we should see enough significant right back in some of the loans that are really underwater now.
Yeah, so that's taking us all the way through to the banking sector itself, because if you look at the current earnings of Stanbic IBTC Holdings, came in a bit disappointing. What's your outlook on these results? What can you glean from the financials, by the way?
Okay, thanks. If we, based on the financials, if we look at the bank struggled in terms of the interest income, means they were unable to increase their loans, and maybe interest on interest yielding assets also came down. But there's also a major line item in terms of trading. Last year it was significantly high, I think almost about 34 billion, and this year I think they made just about 9 billion. So if you recall, the yield environment last year favored a lot of fixed income traders because yield moved downward. So there was a lot of capital gains, and I think maybe the bank took advantage of that opportunity. And this year it was a reverse situation where yields increased significantly, whereby a lot of traders had to book a lot of book significant losses in their books. So yes, the bank is struggling, but we can say the revenue of the bank is significantly diversified, not just banking, a strong asset management, PFA, and we would say, I feel that they should be able to bounce back. And with what they were able to pay as interim dividend, that were provided a bit of support to a lot of investors. The Naira dividend per share, yes, in terms of yield, may not be very attractive, but compared to what other banks pay within interim for the half year 30 kobo dividend, you can still see that that's like 3 times of what other banks are paying. Yes, their share based on share price, their share price is significantly high, so yield won't be very attractive. But by and large, I believe it's a tough time for banks. This year, cost of doing business is also going up, and the economy is just recovering. So opportunities for lending is not very significant.
Thank you for those analysis. Ayodeji Ebo, Head Retail Investments at Chapel Hill, Denham. Have a pleasant evening and see you next time.